Alright guys, turning our attention to the week ahead. The upcoming trading week will run from the 22nd to the 26th of March 2021. And our focus in this upcoming week will be on the euro, the single currency, where the pressures have continued to mount across the board for the single currency recently. Now it seems like the euro just can't catch a break recently, with reasons to say short the single currency stacking up over the past couple of weeks. The first focus area has been on the virus front, where the vaccination rollout has been one of the biggest influential factors pressuring the euro. Now, this chart from ourworldindata.org, this is updated for March 20th, puts the underperformance of the euro or European Union versus places like the US and the UK into perspective in terms of that vaccination rollout, with the EU having vaccinated just 12% of their population versus over 40% in the UK and 35% in the US. Now, with the growing concerns about third waves, we've also recently heard that numerous EU members are tightening restrictions once again, such as France, Portugal, Poland and Italy, and Germany likely to follow, with other officials also saying that they are that there's clear signs right now that a third wave in Germany has already begun. The other factor to consider, of course, is total new cases per day relative to the population size, which also shows a challenge that the EU is facing right now, with the recent rigmarole about the AstraZeneca vaccine that has also made matters worse, as the saga has largely seen a growing distrust for the vaccine among EU citizens, which could spell problems going forward. Now, apart from the obvious health and loss of life concerns, the other factor that the virus and vaccine-related challenges has influenced is the overall growth outlook for the Eurozone, which has already seen downgrades from the IMF in January and is set to see further downgrades in the months to come. Now, looking at some of the recent growth estimates, one would be excused to see the glass potentially half full for the Eurozone economy where compared to places like Australia, New Zealand, Japan and Canada. However, the market is forward-looking, which means that it's not just the current level of expected growth that's important, but whether downward or upward revisions are more or less likely. And arguably, given the vaccine rollout, the higher case numbers compared to the other major economies, and the renewed lockdown restrictions being put in place, the odds for further downward revisions for Eurozone growth is definitely more likely. That also brings us to monetary policy. Now, even though all of the major central banks are still sticking to their dovish guns, there are clear divergences building in what markets are expecting from them. Even though the BOC and the RBNZ are not really contemplating raising rates anytime soon, the expectations from a market's point of view for possible asset purchase tapering has been building for these two banks. And with recent policy decisions, we've seen the Federal Reserve as well as the Bank of England make it very clear that raising rates are not really a consideration right now, nor is reducing asset purchases, but their response towards the recent rise that we've seen in nominal bond yields at the back end of the curve has been far different compared to what we've seen from the ECB. The ECB has basically came out front-loading asset purchases to try and keep yields from pushing significantly higher, and the Fed and the BOE, they seem far less concerned about the moves, having explained that the rise in yields for them is simply consistent with the improving economic outlook. Now, the sanguine approach to rising yields alongside sizable upgrades in the growth outlook from both the Fed and the BOE has seen the markets pricing in faster policy normalization from the two banks compared to something like the European Central Bank. And according to this chart, if we take a look at the euro-dollar futures markets, that is pricing in a first possible rate hike for the Fed by March 2023 and 3 hikes right now by September 2023, and that is after the overly dovish comments from the Fed earlier this week. So similarly, where the markets were expecting a move into negative territory for the BOE less than just 2 months ago, we are now starting to see the markets expecting the next move from the BOE to also be a move higher in interest rates in the next 12 months. So whether we consider the vaccine rollout, whether we consider new virus cases, whether we consider lockdown restrictions, whether we consider growth expectations or monetary policy normalization expectations, on all of these fronts, it does point to further weakness for the single currency euro versus the US dollar and the pound, and also against something like the CAD as well as the Kiwi dollar. Now that brings us to the week ahead, where the only real data point of note will be the latest flash PMI data for March. Now, any major deviations in the data between the EU and the UK and US data might provide some short-term opportunities If we do see EU data coming in way below the market's minimum expectation, and at the same time we see US and UK data printing much firmer or above the market's maximum expectation, that could provide some short-term opportunities to sell currency pairs at market, like the euro dollar, like euro sterling. Alternatively though, if EU data comes out and surprises meaningfully to the upside, while we see US and UK data stay more stable or print lower, that could provide some short-term relief to the upside for euro dollar and euro pound, which can be used as opportunities to simply sell these two currency pairs from better levels. Positioning is another one to consider. That is still suggesting that there is more room to run to the downside for the euro. If we take a look at the most recent CFTC data published on Friday, we saw yet another sizable reduction in net long positioning for the euro, with another 12,000 net long positions being trimmed. And even despite net long positioning already trimmed with more than 75,000 from the start of February, the euro is still comfortably in the lead in terms of the largest net long positioning among the majors, and that further suggests possible room to run to the downside. Now, apart from that, the other key factor to keep on the radar for the week ahead is bond yields, and more specifically what's happening to US 10-year. The jolt to the upside that we've seen in US 10-year bond yields over the past few weeks has provided some upside for the US dollar, not only from a yield differential point of view, but also from its implications on a monetary policy normalization expectation front. So even though the bias for the euro does remain tilted lower against the likes of the dollar as well as the pound, any strong mean reversion to the downside for something like US 10-year this week could see some short-term weakness playing out for the US dollar, which would be more supportive for the euro in the short term. So in terms of sentiment shifts and a trade plan, scenario one, in terms of potential bearish euro outcomes this week, we're looking at, like we said, a miss in the EU PMI data below market expectations, the minimum expectations. That could be further exacerbated if we have a beat in the US and UK PMI data. We can also see some downside for the euro if we see US 10-year continue its rise to the upside. That should be more supportive for the dollar once again. And if we do see further delays in the vaccination rollout or further lockdown measures being put in place, that's another bearish factor to consider for the euro. In terms of possible bullish outcomes is, like we said, a beat in EU PMI data followed by a possible miss in the UK and the US data. If we do see some strong mean reversion playing out for US 10-year, that is to be expected to be more negative for the dollar and thus more positive for the euro. And if we do see any major lockdown or vaccine rollout breakthroughs coming out for the eurozone, that can also be considered as more positive. Do keep in mind that the possible bullish and bearish catalysts are not necessarily dependent on each other, and it's not ranked in order of importance. So each catalyst is a potential bullish and bearish catalyst in their own right. And if combined by other similar bearish or other similar bullish catalysts, are expected to have bigger impact in asset price movements. Also keep in mind that if we do see a strong bullish reaction in something like the euro dollar or euro pound from a combination of these factors, the medium-term bias for euro dollar and euro pound does remain tilted to the downside. So any significant push higher from any or all of these potential bullish factors would be seen as opportunities to simply sell the euro dollar and sell the euro sterling at better levels. Keep in mind that the potential outcomes and the potential market reaction in this report, it's merely a guide for what we would expect in the event of various outcomes. And please keep in mind that the market can always surprise in the way that it reacts. So the expected impact is never intended as trade calls, but rather intended as a mere guideline and framework for your own scenario planning for the week ahead. Alright guys, so that is everything from our side for the week ahead. It is going to be more on the quiet front, so do prepare, use the time to prepare for some upcoming events, do some additional research. As always, good luck with the week ahead, and any questions, please don't hesitate to let us know.